All right, joining me, Jeff Kleintop, Chief Global Investment Strategist, and Kevin Gordon, Senior Investment Strategist at Charles Schwab & Co. Incorporated. Afternoon, guys. Great to see you both here. Mr. Gordon, let's talk some stocks first. We lost the Russell today, it seems, to bonds. Does that fit in your assessment?
Yeah, you've started to dip back into that negative correlation territory between bond yields and specifically small caps. It hasn't yet been the case for large caps, but it seems to be that higher yields, or at least the rise has taken a little bit of a bite out of small caps. I will say, the one encouraging aspect of the rally for something like the Russell 2000 in particular is that breadth has improved quite dramatically. If you're looking at what I think is more of the holy grail of breadth metrics, which is the percentage of members trading above their 200-day moving average, there has been a pretty nice move upwards, and it hasn't been hasn't deflated. So you've gotten consistently kind of in that 2/3 zone for the percentage of members that are trading above their 200-day moving average. I think that's a positive sign. Of course, you need that momentum to be sustained, and you're also still waiting for the Russell to surpass its November 2021 high and at least confirm that the that long bear market is over. But I think that the price action at the individual member level has been somewhat encouraging over the past week.
Yeah, as KG and I were talking, advanced decline still in pretty good shape. We're still sitting near that 6,000 for the S&P. So, I mean, big stocks, when they command those indexes, a little bit more stable, but Russell's really whipping around. Jeff, when you think about how our inflation print this morning fits into the global picture, Fed versus the rest of central banks, what stands out to you?
Yeah, it's interesting. So, the number did come up a little bit, and it was expected to. My favorite leading indicator of inflation is that input prices component of the PMI. And in the US, that's been rising. And it's usually a good 6-month leading indicator of where inflation's headed. So that's been going up. But that's in contrast to what we're seeing elsewhere. Most other countries around the world continue to see that input price component coming down, pushing prices lower. In fact, inflation in the Eurozone is 1.7 and heading lower. It could be 1% or lower in the next 6 months based on that trajectory of businesses and the survey of those on the front end. When they get the orders, they're ordering supplies. They're seeing what the pricing trends are. And that could mean different trajectories for central banks. We've got 50 basis point cuts on tap in December for Canada, Sweden, and New Zealand, and a chance of a 50 basis point move from the ECB. So obviously the numbers for the Fed have shifted quite a bit, but that's not the case outside of the US. And we could see maybe a little bit of a lift there in PE ratios as maybe rates come down more quickly outside the US, given that further downward trajectory in inflation.
Very good point. I think probably why the dollar is up a good bit here today. We're looking at a chart that shows U.S. CPI year over year in the yellow, and the PMI's advanced 6 months to get a little predictive value. Kind of looks like we should expect inflation to stay firm here, Jeff.
Yeah, and that, you make a point about the dollar being firm today. I do think it has something to do with this. And it certainly has something to do with rates, but that's not the whole picture because, we know that the rate move that we've seen has been mirrored in lockstep by the move in Australian yields. Australian 10-year is up just as much as the U.S.'s 10-year is over this quarter so far. And we've seen nearly as big of a rise in European and Canadian yields. I think my conclusion here is that the dollar's move is more in response to potential Trump tariffs. I mean, that's the textbook move. Currency goes up in step with tariffs to negate their impact. I think that's the evidence that the market's pricing in trade risks here, much more so than it is pricing in, a major difference in yield.
I like that. I've been hesitant to explain macro through potential policy, but it does seem like it probably has a little bit more in the dollar than I would say the bond stuff. But Kevin, coming back to the conversation of the day, which is basically this and connecting it into the Fed's potential. Colin Roche at the top of the show was arguing that some of this stuff might be disinflationary. But it's like anyone's guess at this point. We have no idea how really this incoming administration is going to respond to what the Fed's doing. But when we're having conversations about higher dollar, higher yields, I mean, it sounds like maybe some of our framework here might be getting disrupted. Kevin Gordon, take me through it. We got about a minute.
Well, yeah, I mean, there's so many conflicting narratives around policy because you've got on the one hand potentially stimulative things on the fiscal side via tax cuts, or if you're just extending, which I wouldn't view as much as stimulative, you would probably have to go the route of actually, going further with actual tax cuts. But then from a tariff standpoint, yeah, you could potentially, have a hit to growth, but also a boost to inflation. And then even on the immigration policy front, if it turns out to be, relatively aggressive, that to me is a more clear hit to actual growth. You restrict labor supply growth in the country, or if you take out actual labor supply, there is a more meaningful risk there. But I agree with your point. I mean, this is all a guess at this point. We still have a couple of months until, the new administration switches in, and then we have to figure out what is going to be done unilaterally versus what has to be done congressionally. And I would argue too, the sequencing of this really matters. So if you wait a long time until you get something done on the tax front, but within that time frame, if more aggressive things are happening on the tariff front, that's probably more of an equity market volatility driver. You probably don't see a lot of the maybe euphoria associated with tax cuts show up until later. So I think the sequencing matters as much. But yeah, to the point made, that you just made, Oliver, I think that we need to just sort of take a step back, take a breather, and wait for the policy to unroll, as time goes on.
I really like that point about the sequence of events. It's very important because we're kind of thinking about all these things sort of holistically as binary, yes or no, will it happen, won't it happen? But as they actually do happen, then the order in which they do could change the outcome. If certain things are unilateral go quick and then the other ones are lingering and one's negative, one's positive, those things don't offset, right? We got a lot to figure out. So I appreciate that context. Good stuff, guys. Kevin Gordon and Jeff Kleintop.